navigating the U.S. stock markets through GICS classification and sector ETFs. The Global Industry Classification Standard, GICS, is the universal language of the financial markets. Developed by MSCI and S&P, GICS categorizes every publicly traded company into one of 11 economic sectors based on its primary business activity. For investors, GICS is far more than a filing system. It is a roadmap of capital flows. By grouping companies with similar economic drivers, GICS allows us to observe where leadership is forming, where risk is building, and where institutional money is rotating. Whether investors are targeting growth opportunities or seeking stability, understanding GICS sectors and their corresponding exchange-traded funds is essential for investment management. GICS sector weights, a snapshot of market leadership. The pie chart displayed here provides a succinct summary of GICS sector weights based on data as of mid-December 2025. The 11 GICS sectors, trends, drivers, and key players. The U.S. equity market remains heavily concentrated in a small number of dominant sectors. Information technology alone accounts for more than one-third of total market weight, underscoring its role as the primary engine of index performance. Financials represent the second-largest sector and are highly influenced by interest rates and credit conditions. Communication services follow closely, driven by digital advertising, streaming, and platform-based business models. Defensive sectors, such as healthcare, consumer staples, and utilities, represent much smaller portions of the U.S. stock market. This imbalance reflects a market structure that is strongly tilted toward growth-oriented sectors. This concentration amplifies both opportunity and risk. Sector leadership changes can occur quickly and with little warning. We update this video series periodically, so make sure to subscribe to this channel for regular updates. Channel subscribers can email us at qeinvesting@gmail.com to request unlisted private videos or playlists at no cost. The 11 GICS sectors, trends, drivers, and key players. Each GICS sector is shaped by its own economic forces, industry structure, and long-term growth drivers. The table here summarizes the relative weight, dominant trend, and flagship companies that define each sector's performance. Together, these sectors form the structural backbone of the U.S. stock market. Understanding each GICS sector in detail. Below are brief introductions to the 11 GICS sectors. 1. Information technology. Weight is about 34.6%. Technology serves as the engine of the U.S. stock market, driving overall performance through innovation, scale, and capital investment. Performance in this sector is driven by AI capital expenditures, cloud infrastructure, and semiconductor demand. A small group of mega-cap leaders exerts outsized influence, making this sector the primary driver of broad market moves. Key companies include NVIDIA, Apple, and Microsoft. 2. Financials. Weight is about 13.1%. Financials form the backbone of the U.S. economy, reflecting the health of credit markets, interest rates, and financial activity. Financials are highly sensitive to interest rates, yield curve dynamics, and credit conditions. Banks and insurers benefit from stable growth and higher rates, but face pressure during recessions or periods of credit stress. Key companies include JPMorgan Chase, Visa, and Berkshire Hathaway. 3. Communication services. Weight is about 10.7%. This sector is driven by digital platforms that monetize user engagement through advertising, subscriptions, and content distribution. This sector is extremely top-heavy. Digital advertising, user engagement, and streaming economics drive performance. Key companies include Alphabet, Meta Platforms, and Netflix. 4. Consumer discretionary. Weight is about 10.3%. This sector reflects discretionary consumer spending that rises and falls with economic confidence and income growth. This is a classic cyclical sector tied to consumer confidence and wage growth. It thrives during economic expansions and contracts quickly during downturns. Key companies include Amazon, Tesla, and Home Depot. 5. Healthcare. weight is about 9.8%. Healthcare combines stability with innovation. Insurers provide steady cash flows, while pharmaceuticals and biotech introduce upside potential along with risk through drug development. Key companies include Eli Lilly, United Health Group, and Johnson & Johnson. 6. Industrials, weight is about 8.0%. Industrials represent the builders of the economy, tied closely to manufacturing, global trade, and government infrastructure programs. Aerospace and defense play an increasingly important role. Key companies include General Electric, Caterpillar, and Honeywell. 7. Consumer staples, weight is about 4.9%. Consumer staples provide essential goods regardless of economic conditions, making the sector a common destination during market stress. Key companies include Walmart, Costco, and Procter & Gamble. 8. Energy. Weight is about 2.8%. Energy stands apart as a commodity-driven sector shaped by prices, geopolitics, and supply dynamics. It often behaves independently of the broader market and can outperform during inflationary or geopolitical shocks. Key companies include ExxonMobil, Chevron, and ConocoPhillips. 9. Utilities. Weight is about 2.4%. Utilities offer stable dividends but carry heavy debt loads, making them highly sensitive to interest rate changes. Key companies include Duke Energy, NextEra Energy, and Southern Company. 10. Real estate. Weight is about 1.9%. The real estate sector is primarily composed of REITs. It benefits from falling or stable interest rates and is pressured when financing costs rise. Key companies include Prologis, Equinix, and American Tower. 11. Materials. Weight is about 1.7%. Materials provide the raw inputs that power industrial activity and economic expansion. Key companies include Linde, Sherwin-Williams, and Freeport-McMoRan. Sector ETFs, turning GICS into tradable signals. Sector ETFs convert GICS classifications into liquid, investable, and hedgeable instruments. They allow investors to express macro views, manage portfolio risk, and trade volatility at the sector level. In the table here, we summarize GICS sectors and their representative ETFs. Why sector ETFs matter more than ever. Most investors do not buy every stock in a sector. Instead, they use sector ETFs for instant diversification and precision exposure. Tracking the relative performance, trading activity, and volatility of sector ETFs provides clear signals about shifts in market leadership and risk appetite. For example, when technology, XLK, weakens while consumer staples, XLP, strengthens, it often signals a shift toward a defensive, risk-off environment. Sector ETFs and their options provide flexibility that individual stocks often cannot, especially during earnings season and macro-driven volatility. Final takeaway. GICS is not merely a classification system, it is a map of the market's economic DNA. When combined with sector ETFs, it becomes a powerful framework for understanding market direction, managing risk, and identifying opportunity. Rather than asking which stock will move next, GICS encourages a more durable and strategic question. Which sector is gaining influence, and why? We hope you find this video informative and useful. Please give us a thumbs up and subscribe to this channel for anytime access to this and other videos. As a subscriber, you can request private videos or playlists by emailing us at qeinvesting@gmail.com. Thanks for watching and catch you in the next one.